If you are in the market for a new car, you can now save money by buying one that's built here in the U.S.
Under the One Big Beautiful bill signed by the president on the 4th of July, you can now deduct the interest you pay on your loan.
The first loan a dealer shows you is almost never the best one. And that's not a mistake. You think you're being approved, you're actually being directed, because before you ever walked into that dealership, someone already decided which loan you'd see first. And it wasn't based on what saves you money. It was based on what protects them. Most buyers don't realize this until years later, when the payment still hurts and the car is worth less than the balance. But then the damage is done. In this video, I'll show you why dealers push one specific loan first, how authorities used to shut down questions, and how a single recommended option quietly locks buyers into the most expensive path without them ever noticing. If you're shopping for a car, or about to, this is the rule they hope you never learn. The first loan you're shown is never random. Most buyers believe the first loan a dealer presents is the best one available to them. That assumption feels logical, especially after hours of negotiating, paperwork, and pressure. When a finance manager slides one option across the desk, that the brain treats it as guidance, not strategy. Approval sounds like advice, and advice sounds safe. Dealers understand this psychological shortcut, and they rely on it heavily. The phrase best option is never neutral language. It frames the conversation before the buyer even knows what alternatives exist. Once framed, the decision stops feeling like a choice. The buyer assumes that approval equals recommendation and recommendation equals protection. That assumption shuts down comparison instantly. In reality, the first loan shown is selected long before the buyer sits down. It is chosen because it fits the dealer's incentives, not the buyer's interests. Authority bias does the rest of the work. When an expert presents one path confidently, most people stop questioning. The finance office is designed to amplify that effect. The buyer is tired, mentally spent, and eager to finish. Time pressure replaces curiosity. Silence is used strategically. If the buyer doesn't ask for alternatives, none are offered. Comparison never happens openly because it threatens the structure of the deal. Showing multiple options invites scrutiny, math, and hesitation. Hesitation slows the sale and risks losing control of the narrative. So the safest move is to present one loan with confidence and move forward. The buyer feels guided, not managed. By the time questions surface, the paperwork is already underway. What looks like a recommendation made for you. The first loan is never random, in a process designed to feel helpful while protecting everyone but the buyer. Once accepted, that starting point shapes every conversation that follows. Rates, terms, and monthly payments are all built. Changing direction later feels disruptive, awkward, and risky. So most buyers stay on the path placed in front of them. What began as a suggestion quietly becomes a commitment. That is why the first loan matters more than any other option you never see. Once that frame is set, every future decision you never knew you were making, until the costs finally surface years later, long after the paperwork felt finished. How dealers decide which loan comes first. Dealers don't choose which loan to show you based on what saves you the most money. They choose based on relationships, incentives, and reliability. Every dealership has preferred lenders. And those lenders aren't preferred because they offer the lowest rates. They're preferred because they make the dealer's job easier and more profitable. Lender-dealer relationships are built on consistency. Some banks approve deals faster, ask fewer questions, and tolerate higher risk. That speed matters. A fast approval keeps the buyer engaged and reduces the chance of hesitation or second thoughts. Slow approvals kill momentum, and momentum is what closes deals. Back-end incentives play a bigger role than buyers realize. Dealers earn money not just from selling the car, but from the financing itself. This includes reserve spreads, volume bonuses, and incentive tiers. A lender might pay more per deal or offer quarterly bonuses if the dealership sends enough volume their way. None of that benefits the buyer, but it heavily influences which loan gets pushed first. This is why the lowest APR is rarely presented up front. Low-rate loans often come with stricter requirements, lower margins, or more paperwork. From the dealer's perspective, they create friction So they're kept as a fallback option, not a starting point. The first loan shown is usually the one that balances approval odds with dealer reward. It's safe, predictable, and profitable. The buyer assumes it's optimal because it's presented confidently. In reality, it's simply efficient for the dealership. Volume and commission logic drive everything here. Dealers don't think in single transactions, they think in pipelines. One loan might pay slightly less, but if it closes faster and counts toward volume targets, it's more valuable overall. Multiply that logic across hundreds of buyers and patterns emerge quickly. By the time a buyer sits down, the decision is already structured. The lender wasn't chosen because it's best for you. It was chosen because it fits the dealership's operating model. The buyer never sees the full menu, only the option that keeps the system moving smoothly. Understanding this changes how you interpret approval. It isn't a favor. It's the path of least resistance for the people on the other side of the desk. The hidden rule. Most buyers don't know. Most buyers believe loan approval is simple. You apply, the bank decides, and the best option appears. That belief is wrong. Inside dealerships, approvals follow a hierarchy, and that hierarchy has nothing to do with saving you money. Every dealership operates with an internal approval order. Some lenders are placed at the top, others further down. This order isn't based on APR alone. It's based on predictability, speed, and how little friction the lender creates for the dealer. When a buyer is approved, the approval didn't just happen. Some loans are considered protected. These are lenders the dealership prioritizes because they deliver consistent outcomes. They approve quickly, fund reliably, and rarely challenge deal structure. Dealers protect these relationships because they keep deals moving. Protected lenders get first position by default. Risk is quietly offloaded in this process. Higher interest rates aren't just about profit, they're about insulation. When a loan carries more margin, more easily, missed payments, early defaults, or depreciation matter less to the system when the loan aggressively upfront. That risk isn't eliminated. It's transferred to the buyer. The buyer never sees this. From their perspective, approval feels binary, approved or denied. But behind the scenes, options were filtered long before the paperwork reached the desk. What you're shown is what fits the system's tolerance, not your long-term cost. This rule favors speed, not savings. A loan that approves in minutes beats one that takes hours. A lender that never questions income beats one that scrutinizes details. Speed keeps momentum alive. Momentum closes deals. Savings slow everything down. Low APR loans disrupt this flow. They demand cleaner credit, tighter verification, and more time. Time creates doubt. Doubt creates questions. Question risk cancellations. So these loans are deprioritized, not because they're bad, because they're inconvenient. The hidden rule is simple. The best loan for the buyer is rarely the best loan for the process. The system optimizes for efficiency, volume, and control. Buyers assume approval means success. In reality, approval just means you fit the path designed to keep the machine running without interruption. The authority trap in the finance office. By the time buyers reach the finance office, they are already exhausted. Hours of negotiating price, trade value, and add-ons drain mental energy. The brain shifts from analysis to relief. Finishing the deal becomes the priority, not optimizing it. This fatigue is not accidental. The finance office is positioned after the hardest decisions. When buyers are tired, they defer to authority. They want closure, not complexity. That is where the phrase, "this is what you qualify for," does its work. It sounds definitive. It implies evaluation, judgment, and finality. Buyers hear it as a statement of fact, not a framing choice. Qualification feels like an outcome, not an option. Authority bias fills the gap. When someone in a suit behind a desk presents information confidently, most people stop challenging it. The buyer assumes the decision has already been made by systems they cannot see or influence. Questioning feels pointless, even rude. Silence is used as pressure. After presenting the loan, the finance manager often stops talking. That pause isn't neutral. It invites acceptance. Humans are uncomfortable with silence, especially in high-stakes settings. Many buyers fill it by agreeing. Asking questions here feels risky. Buyers worry about appearing difficult. They worry about delaying the process. They worry about losing approval entirely. So curiosity shuts down. The desire to be done overrides the desire to understand. This is why buyers stop asking questions in the finance office, not because they don't care, but because the environment discourages it. Fatigue lowers resistance. Authority replaces explanation. Silence pushes compliance. By the time paperwork is printed, the loan feels inevitable. What began as a suggestion now feels like the only path forward. The buyer signs not because they're convinced, but because the process has quietly removed alternatives. The authority trap works because it doesn't feel like pressure, it feels like professionalism. And by the time buyers realize they could have asked for more options, the deal is already finalized and difficult to unwind. Once control shifts to the process, recovery becomes rare. Buyers leave believing compliance was required, not chosen. That misunderstanding is powerful. It keeps people silent today and resentful later, paying for decisions they never fully questioned, when questioning would have changed the outcome. Without conflict, confrontation, or embarrassment in the moment during a stressful purchase environment designed precisely. How this one loan shapes your next 5 years. The first loan you accept doesn't just determine your payment. It quietly scripts the next 5 years of your financial behavior. Everything that follows, stress, flexibility, and options, traces back to that single starting point. The monthly payment illusion is where it begins. Buyers anchor on one number and stop evaluating the structure behind it. If the payment feels survivable, the deal feels safe. What's hidden is how much time, interest, and depreciation are packed into that comfort. A manageable payment today often means extended exposure tomorrow. Over time, the real cost reveals itself. Interest accumulates slowly but relentlessly. Each month, money flows out while the car's value declines. The buyer feels stable, yet the math is moving against them. By year 2 or 3, the loan balance and the vehicle's worth no longer align. That misalignment is how negative equity forms. It doesn't appear subtly, it grows quietly as depreciation outruns principal reduction. Longer terms slow payoff, just enough to keep the buyer underwater longer than expected. Repairs arrive while the loan is still active, adding pressure to an already stretched budget. Owners delay maintenance. They avoid selling. They hesitate to make improvements. The car stops being transportation and starts being an obligation. Every decision is filtered through what the loan allows, not what the owner prefers. Switching later feels logical but becomes expensive. Trading in early means carrying debt forward. Refinancing often requires better credit or longer terms. Selling privately rarely clears the balance. What felt like flexibility at purchase becomes rigidity over time. The loan locks in a path. Monthly commitments limit saving. Repair costs stack on top of payments. Insurance remains high. By the time the buyer wants out, the cost of leaving feels worse than staying. This is how one loan shapes 5 years. Not through a single bad moment, but through accumulated constraints. The buyer keeps paying, not because the deal is good, but because every alternative feels financially painful. What looked like an easy decision becomes a long-term anchor. And by the time the loan ends, the habit of financial limitation often remains, shaping the next purchase in the same way unless the structure is questioned before the cycle starts again. The loan you're shown first doesn't feel dangerous. That's exactly why it works. It doesn't hurt immediately. It limits you slowly, month by month, decision by decision, until staying feels easier than questioning and leaving feels too expensive. By then, the structure has already done its job. Dealers don't need you to make a bad choice. They just need you to accept the first one. That's why Bidding for Autos exists. This channel isn't about hype or shortcuts. It's about breaking down how these systems actually work, so buyers don't confuse approval with advice or authority with the honesty. If this video helped you see car loans differently, like it so it reaches more people before they sign, subscribe to Bidding for Autos if you want more clear, no-nonsense breakdowns of the auto market, and share this with anyone who's about to buy a car and thinks that the first option shown is automatically the best one. The system wins when buyers don't ask questions. Understanding is how you stop paying for that silence.